Thanks for coming in and joining us here today, online, classroom. I'm glad that you could be here. I want to share some information with you today that could really help to make you a super effective investor. Now listen, as an investor myself, I can tell you I've made some mistakes, and I've made mistakes that have cost me six figures. But the best way I know to avoid mistakes is to learn how to read the market. There's nothing worse to me than talking to somebody who's overpaid for a piece of investment property. I don't want you as an investor to ever overpay. Now, being in the property management business and also have been in real estate and being an investor myself for about 30 years now, I can tell you I've made those mistakes. And I talk to people all the time that make those mistakes. And I sometimes wish that people would talk to me before they got into a piece of property, but obviously that's not practical for everybody to do. Many people will call me as a property manager after they've already bought it. And at that point, I can't make any comments on what's paid, what the rents are. All we can do is effectively do what we can to help that property to cash flow. You see, I firmly believe that an informed investor is a successful investor. So we do these classes to help you become a successful investor. As a successful investor, you need to understand what's going on in your market. You need to know what to look at so you can look at the market. See, the real estate market has the same cycles as a stock market. It's not as volatile as a stock market, which is really cool because you can look at the indicators on the real estate market and you can tell where it's going generally about 6 months before it gets there. And you can't do that with the stock market because the stock market could change in 6 minutes or 6 seconds, but real estate is much less volatile. That makes it cool. Real estate also produces guaranteed income. So as an investor, I want you to understand what you need to be looking at so you can tell what's going on in the real estate market. Whether you're investing here in our local market as Brevard County, maybe you are working in properties that we are managing for you, in which case I really appreciate your business and it's an honor to be able to work with you. Or maybe you're looking at other areas of the country. You can use what I'm going to show you here to be able to look at any market in the U.S. and start to know what's going on. The whole key is you know your market and you will never overpay for a piece of property. So let's dive into this and kind of go through. I'd encourage you to take some good notes. And as always, you should be able to email me or give a call with any questions. We're happy to share any of that information. So I want you to understand what we're looking at when we get to the market and things that we're going to talk about today. We're going to talk about market cycles. We're going to talk about what those cycles mean and how they could affect you as an investor. We're going to look most importantly at the 5 major indicators that you want to look at in your real estate market. These 5 indicators are things you can look at that help tell you which direction your market, whichever market you're investing in, is going to go. Up, down, sideways. What are we looking at? And that can help you to gauge what your strategy is. We're also going to share with you how to read those indicators, what they kind of mean. And lastly, I'm going to close out. I'm going to share with you all the websites where I pull this data from myself. These are free sources where you can pull the information that I'm sharing with you so you can look at. Many of these websites that I'll share with you, they do have paid services that you can subscribe to, but everything that I'm sharing with you today is something I pulled up for free, and you can too. So let's take a dive in. Let's start off by understanding why you need to understand, or why you need to have this information, because you need to be a successful investor. If you're buying 1 rental property or 100 rental properties, you really need to understand exactly what you're purchasing. Now, anytime you're buying a rental property, you need to think about income. Rental equals income, so you're buying an income stream. So your analysis of the market and of the property needs to be based on how much income it generates. And in order to generate that income, it really helps that you understand the trend. You see, a successful investor is an informed investor. And a great real estate investor, they're great because they read the trends. They understand the data that I'm here to share with you today so that you can see what's happening or what's about to happen in your market. You can develop a system knowing exactly what I want to pay. Here's my formulas. I don't want to pay more than this percentage of median income. I want my rents to be this percentage of my purchase price. And you can develop a system that's going to give you solid, dependable cash flow, and it's going to help you to be able to work a strategic plan. The worst thing you can do as an investor is make an emotional decision. Every property that you buy as an investor, whether you're buying it to fix and flip it or you're buying it to rent it, no matter what your strategy that you're looking at, it should be about the numbers. That means you had to understand the trends, you need to know what your exit strategy is, know what your system is, and you need to work a strategic plan. That helps you to be successful. Now, I want you to understand that there's 4 cycles to the market. Stock market, we know, goes up and down. Well, so does the real estate market. But as I said a minute ago, the real estate market is not nearly as volatile as the stock market. So let's take a look at the 4 cycles on the market real quick. First of all, we've got the bottom cycle. This is where it all starts. Now, we saw the bottom start to fall out in 2008, but it didn't bottom till really about between 2009, 2010, and 11. So 9, 10, 11, we're kind of at the bottom, and late 11, early 2012, it started to climb back up again. But our bottom, when you see a bottom, you know inventory levels are high. It means there's lots of homes available on the market, and sales are low. This is a great time to buy because even in a market like this, people still need a place to live. And that's why rental property is a good investment in any market. Now, when the real estate market crashed in 2008, my family and I lived off of our rental properties. I mean, that was our income that sustained us during that downturn because we really couldn't do much else in the real estate market, but we still collected rents every month. What that taught me was that we had solid income coming in even in a bad economic time. It's market-proof income. And at the bottom of the market like that is a great time to buy because values are low, but rents are still high. After the bottom, the market starts climbing. When it's climbing, now interest is rising. Now at the bottom of the market, inventories are high and sales are low because people don't want to buy, so they rent. But when it starts climbing, people become interested in investing again. They become interested in home buying again. Now they start to think, wow, property might gain in value, so maybe I should buy something so that I can earn a little extra income off of it. Inventory starts to drop and sales volume increases. When you see this starting to happen in a market, that's a good time to start buying because now your market's climbing. Your rents are going to climb, your values are going to climb, and that means if you're buying property here, you hold it for a couple of years, it's going to be worth here. Everybody wants to buy when it's climbing. Sadly, most people buy when it's peaked because they're afraid they're about to lose out on more value and they end up crashing. But now I'm ahead of myself. See, after it climbs for a little bit, we eventually hit the peak. Now, at the peak, this is when everybody's doing it. Everyone is talking about it. Now, in 2007, I went on a field trip with one of my daughters. And when I got on that bus full of 4th graders to go on a field trip for the day, I heard the teacher, my daughter's teacher, talking about how she was pulling equity out of her home to buy investment property. And then I heard 4th graders talking about how their parents were doing it. Now, when 4th graders are talking about buying investment property, we're at a market peak because everybody's talking about it. We're kind of there right now in our market. If you walk around town and you just listen, I love to go out to dinner and kind of, not really eavesdrop, but sometimes you can't overhear, or can't help but overhear the conversation next to you, and somebody's talking about real estate prices and volume and everything else and equity, and they can't believe what they can sell things for. Everybody's talking about it again. That's a sign of a market peak. And then after a market peak comes the dreaded downturn. I think we're at the front end of a downturn, but I'll share with you the indicators. You can make your own decision on that. In a downturn, we see sales activity slow down. That means there becomes fewer and fewer sales that happen each month. Inventory increases. That's one of the biggest things that happens in a downturn, and we're starting to see inventory increase in many places across America right now. When inventory increases, suddenly you got more sellers than buyers. The law of supply and demand kicks in and property values decline. And then another thing happened, foreclosures go on the rise. The reason we see foreclosures rise in a downturn is because, unfortunately, most people in America are taught the fallacy that your home is your biggest investment. Folks, I want to set that clear right now. Your home is not an investment. It's not. It's not an ATM machine. It's not a get rich quick. It's not a build wealth. Your home is for peace of mind and solitude for you. It's a place for you to live. It's sanctuary. It's a place for you to retreat from the world every day. You buy a home so you can have stability and not have to move every year if you're renting, but it's not an investment. Unfortunately, Most people in America, it's taught as an investment. So as prices go up, what do? They spend themselves to where they're in debt, and then to get out of debt, they refinance, pull cash out of their house to pay off all the credit cards, and then they buy more toys because they never dealt with the spending issue. And now what happens? They got a higher mortgage payment, they keep spending, their debt comes back up. Well, eventually they hit a place where they can't keep pulling cash out of the ATM machine they call their house. That means now they've still got the spending problem, they've got the debt problem, they've got the higher mortgage payment. Boom, we go into foreclosure because they can't keep refinancing. If that's you, I want you to break that cycle right now. If you're pulling cash out of your home to buy investment property that generates income, as long as it's positive income, that can be good. But if you're pulling cash out of your home to pay off debt and to still buy more toys, you're a foreclosure waiting to happen. So be very careful on that. Your home is not an investment, it's your sanctuary. So these are the 4 cycles of the market. We have the bottom, we have the upturn, we have the peak, and then we have the downturn. And the average cycle takes about 10 years. Now, we started climbing in our real estate market in late 11, early 12. Here we are in early 22 right now. And if we're on that 10-year cycle, then we would be at about a peak. Prior to that, the last cycle ran about 10 years, where it started climbing in about 06, 07, 1996 and 1997, and it peaked in 06, 07, and then crashed in 2008. So if we're following that same historical cycle, just the natural cycle says that we're at a peak now, and we know what's coming would be the downturn. So that's the natural cycle, and if you track the real estate market back through history, it's tended to follow that 10-year cycle. In order to understand what cycle you might be in, you might want to take a look at these indicators. Now, these are key indicators that are going to tell you what's going on in whatever market you're investing in. Whether you're looking here in the Space Coast of Florida, where I own properties and we manage multiple properties through our real estate management firm, or you're looking in Tucumcari, New Mexico, or Idlewild, Virginia. I don't even know if there is an Idlewild, but you get the idea. It could be any town in America. You can use these indicators to start to see what's going on. So the indicators we're going to look at are existing home sales. We'll look at new home permits. We'll look at loan defaults, foreclosure sales, and interest rates. You can pull up all 5 of these in real time at these websites that I'm going to share with you. And this is information that you can pull down for free, and you can zero it in to any market and really see. And I'll share with you where I got that data. But let's start taking a look at why these indicators are important and what is going on in our market. Let's start first with existing home sales. Now, this is one of the best indicators because this is measuring sales of homes that were built previously. They've already been occupied by at least one owner, and now they're on the resale market. Existing home sales is a great way to measure supply and demand. There's more homes existing that are being built. So existing home sales becomes one of the biggest indicators we can look at. It is one of the best ways to read market activity. Existing home sales is a way to measure the buyer's demand, and it's buyers who create demand. When people are buying, they're creating demand. We've had a lot of buyers out the last couple of years. Between the COVID shutdown that's driving people to create a better sanctuary of home and demanding prices, it's also caused some would-be sellers to pull their homes off the market because they didn't know what they would do if they sold it and were kind of afraid to move, didn't know what was, a lot of unknowns that happened during the COVID pandemic that really impacted the real estate market in a negative way. It cut down on inventory a lot, but it also increased demand, which is shooting prices up and contributing to inflationary cycle. When this market changes, you need to understand one thing. It didn't change because of economic conditions. It changed because people quit buying. See, prices don't go down because people are selling. Prices go down because people quit buying. So this existing home sales measures buyers' demand, and buyers' demand is what's going to drive our market. So it's kind of key to be able to look at. Let's take a look at this chart. This is U.S. existing home sales. We pulled this down from Trading Economics, and they track their data from the National Association of Realtors. Now, Trading Economics, it's one of the websites I'll share with you. You can get into their website and look at all kinds of cool data. Now, if you know what you're looking at, you can go to their website, you can go in the top right-hand corner, you can click search, and I just start typing in house, and all the different trackers that track the real estate market will come up. So you could track just about anything in there. It's very interesting. Now, the red lines I added, and this goes back to my stock trading days, because I used to get up early in the morning and trade on the NASDAQ futures, and I would chart out for about an hour from just before the opening bell till after. And so I'm kind of programmed after doing that for a while to look at any of the chart and just automatically start drawing lines. Now, if you're not familiar with charts, a real quick crash course here. When you look at a chart, by drawing a line on the bottom from low point to low point, I can start to establish a pattern, and the bottom creates a floor or support. And you can see how the market's gone up and it'll come down, test support, then go back up, test support. And then here it breaks out of support. When it breaks out like that, that tells you something wild is changing in the market. We draw a line across the top because that creates our ceiling or resistance, and that usually is the place where it doesn't go above. And you can see where it came up and it tested that ceiling a few times. But what happened when our market broke our support here and then shot back up? It became Mr. Toad's wild ride. This thing just kind of went out of control. But what happened is a new trend started to establish, and that's a downward trend. So this is U.S. existing home sales. Notice that we're up here into 2022, so this is real-time information, and we tracked it back. I think I did 5 years on this, maybe a little bit more, but you see the definite downward trend that started to develop on this. So I also use this site to use their forecasting tools. So I put in a request to forecast what was going, and you can see where Trade Economics begins to forecast existing home sales. That's a downward trend. That means people quit buying. That doesn't mean people quit selling. People could still be selling, but if there's fewer buyers and sellers are still listing at the same rate, pretty soon you start to see inventory grow. And as inventory grows, then there's demand that changes, prices start to stabilize. It's not a bad thing to happen. After the crazy market for the last couple of years, I could get excited about seeing a downtrend. Now, we're looking at the macro market right now. By macro market, I mean we're talking about U.S. national averages. So we also want to consider the micro market. Now, before we're done here today, I am going to pull in some micro market information on what we've got going on right here in Brevard County, the Space Coast of Florida, because I know if you're listening to me, could be because we're managing your property or you're looking to invest here. So I want you to understand what's happening in our market as well, but I want you to understand how to use these tools to go into any market. Now, I wanted to also add here this chart. This is U.S. new home sales. Now, when we're looking at existing home sales on this chart, you see how it was an upward trend, and then it broke and began a new downward trend. I could draw a line here because we've got a downward trend that has developed, and we see where the downward forecast is going. But I added new homes because I think new homes is good to look at here for this reason. We've got about 5.8 million new starts going on in the last year. That's the lowest level of new homes being built since the 1930s, since Great Depression era. Yet population is much bigger. So that tells me we've still got a lot of demand on housing. We also see these institutional investors that are buying. In fact, a big Wall Street firm through Goldman Sachs just bought an entire subdivision in Palm Bay, Florida here. I think 67 homes, if I remember the number correctly. Don't quote me on that. You can look it up. But they did buy an entire community, Cypress Bay, Cypress Cay, something like that, Cypress. They bought the entire community to turn it into rental homes because they recognized this important fact. There's a demand for housing, but housing's becoming unaffordable. So as an investor, they're buying it to produce an income stream. Hint, hint, you as an investor need to be buying houses to produce that income stream. Now, I'd love to be able to put together a fund that can compete with these Wall Street firms and enable people like you and I to put in our money into a kitty so that we can benefit from this strategy. That means we want to recognize the demand on housing and capitalize on the income that can be produced. So that being said, let's come back to new home sales. We tracked this back for 5 years, and you can see how we had our floor and our ceiling, established our support and a resistance, and we had a nice trend, and then suddenly it broke out. Again, look, a new downward trend has developed. We could draw that line here, downward trend, and interestingly enough, when we look at our forecast, we've got a downward trend in new home sales. Economists aren't talking about it in our media, but they are forecasting a downward trend on our U.S. home market. I believe some parts of the country are already seeing this. Here in Brevard County, now I pulled this up through Realtor.com because I wanted to show you we still have a very high demand. Now we're pink, we're not red. Red is the hottest area. We're pink, and we're starting, I think, lose a little bit of steam, but we've still got a very anemic supply. In March of 2021, there was 1,005 listings available in our board of realtors. In March of 2022, 787. Now, in the last 30 days, that's increased by 30% to be over 1,000. 30% increase in 30 days is a pretty dramatic increase, and a lot of that's tied to the interest rate changes that have happened in the last 30 days. That's caused people to cancel contracts. I see a lot of properties back on market, but I still see the number of listings still coming into the market, but it's still very much a seller's market. Let me put this in perspective. When I look at this and I see the demand, I see we've got low listings, even at 1,000 listings. When we sell an average of 1,200 homes per month in our local small county, that means we've still got less than 1 month's supply. So it's still very much a seller's market. So if I look at existing home sales here, I can see that we still have a very high demand. That's taking a look at our micro market. A little different than the projection there, although I do see signs with increasing inventory that we could be heading that same direction. Home building permits is the next indicator we want to take a look at. This represents the single largest industry in America, home building, construction. It's about 15 to 20% of the U.S. economy. I once heard it said that every time somebody buys a house, 4 jobs are created. Now you think about that, you've got the builder, you've got the yard crew, but then you've got the restaurateur, the grocery person, all those that now start to serve the people that are moving into those homes. This is a huge part of an economy, and it just the construction part accounts for a very large percentage of our GDP. So you watch new home building permits, that can give you an indicator on where the overall economy is going. More permits equals higher demand. So new home permits is a key thing to look at. The U.S. Department of Commerce tracks 11 different indicators in its projections of what's going on with the economy, but new home permits is one of the most accurate out of everything they track. So if our Department of Commerce is tracking this, don't you think it's important that you look at it as well, because it's really going to be an indicator of what's happening in the market? So let's take a look at housing starts. Now, I went back on this about 25 years. So we're back here before 2000. See, we had a nice upward trend until we hit our peak in 08, and then it fell down and it stayed low because in most markets it would cost a builder more to build a house than they could sell it for. That kept building low. But as values started to climb, building increased. You recognize this little bump here? That's the same bump we saw in existing home sales and new home sales. This is what happened in the COVID recession. It threw everything completely out of whack. We do still see a little bit of an upward trend coming, way off from where we were in 2008. So definitely not as healthy of economy as we had before the crash. Maybe that was a little bit hyperinflated there. Let's take a look at this going back over time. Now I'm back in here to probably about 1960. And over time, housing starts has been in a downward trend. And you can see that here. In a downward trend in a growing population, that means we've got still a very high demand on housing, which means you need to own rental property. But it also tells me that people aren't buying new homes, not at the rate that builders obviously would like to sell them. That's an indication that we could be heading for economic trouble, especially when I see a strong downward trend like this. So something to look at. In fact, when we look at the forecast on this, look where Trading Economics forecast for new housing starts. Again, we see a downward trend. You're starting to see a trend develop in our market right where we're at right now, most of the forecasters. Now, we've just looked at the first 2 leading indicators, and I did throw in new home sales. So we looked at existing home sales, and we looked at new housing starts. And we threw in new home sales, but they're all showing downward trend projections, and that means downward in price, potentially. The next thing we want to look at here is going to be mortgage loan defaults. You remember at the beginning of this session, I talked about how most people look at their home as an investment and they cash it in on an ATM and that drives them to foreclosure. Well, this means now when you start looking at loan defaults, you're actually seeing the volume of people that are saying, hey, I can't afford my house anymore, and they're making the choice to buy groceries or gas or something instead of making a mortgage payment. That's a pretty tough choice, and I'm afraid in this economy we might see people starting to make that choice more and more when you consider inflation, the devaluation of the dollar, the shortage of commodities, a looming food shortage, or anything that you look at that is forecast in our future. You can see that more and more people might be making this choice. Well, if they're making this choice, then that means that loan defaults are going to increase. Now that's an indicator of the local economy. The higher the loan defaults, the more families you've got that are suffering. They can't afford their houses. That means more homes are going to be coming onto the market. Defaults directly affect pricing because these are homes that are about to go on the market. So they're going to add inventory, but it's also taking buyers out who cannot not qualify. Now, if you own rental property, those people still need a place to live. They're probably going to move to someplace more affordable than the home they can't afford, but they're still going to need a place to live, which means you should own rental property so you can be able to provide them a home and provide you an income stream. See, when mortgage loan defaults increase, it creates motivated sellers. I've been in this business for about 30 years, and I can tell you every down cycle, when I see loan defaults go, I know we can do creative financing. I know we can do all kinds of cool stuff, and it's going to create more motivated sellers. Let's take a look at this chart that's put out. This chart tracks delinquency rate on single-family residential mortgages. Now, we're going back here to early 2018, and you can see how that fell until we hit this COVID blip, and it started to come up, and then it shot up rather dramatically. A lot of people during that time were displaced, some for a short period of time, some for a long period. We know it affected the economy. Many people missed a couple of payments and then just elected not to go back paying. They got used to not paying and they decided to stay. And when that moratorium on foreclosures lifted earlier this year, you started seeing those defaults start to hit the market. Well, what's happened is some of them went back to work. It caused it to go down, but look what's happened here. We're starting to see a little bit of a bump again. Again, national average, not local. This is macro market, not micro, but you can look at this micro, and we're going to do that here in just a second. The next thing to look at is going to be foreclosure sales. So we just looked at default rates, delinquency rate. These is measured the people who were missing house payments but haven't necessarily gone into foreclosure yet. So you might call these pre-foreclosure because they haven't actually gone yet. Some of these people are going to sell before it gets there. Others are going to bail themselves out or borrow themselves out, but they're still delinquent, so it's an indicator. But if they don't save it, they wind up in foreclosures. Now, when you have foreclosure sales, it's because demand is low. It's because prices are falling. These people that get into this economic trouble with their house and can't afford to pay, they end up in putting their houses on the market. They can't sell it. It turns into a short sale where they're trying to sell it for less than what's actually owed. And that creates a glut in the market, which means you've got choices to make if you're a buyer or an investor looking to buy property. This is also an indicator the local economy is weakening because more and more foreclosures are coming on the market. Now, when you're looking at foreclosure sales, when it decreases, it indicates a bottom, but when it starts to increase, it indicates a top and the beginning of a downward trend. So definitely something you like to look at. So let me back up a couple of slides here. When we saw it decreasing all these years, we knew we're in a upcycle. When we see it start to increase, and we did see prices level off for a little bit, and then when it started to decrease again, housing prices started to shoot up. Of course, inflation took over, but now that we see this little bump again, it's an indicator that we could start seeing some changes in the market. Take a look at this chart here, which tracks U.S. foreclosure starts going back to, about 2005. You can see it really peaked out here in the market crash of 2008, and it's kind of leveled off since. But you see how we're starting an upward trend back over here again, starting in second quarter of 2020. Now we're third quarter of 2023, and we've got an upward trend that's developing there in the foreclosure starts, meaning that people have fallen far enough behind that the banks are starting foreclosure process. That's not a good thing. Now, we're far, far, far from 2008 levels, but it's still something that kind of makes you go, And then I like to take a look at this. This is a chart that's ranking the 50 states on foreclosures. Now, it's listed alphabetically. But what's interesting is when I get down here to Florida, which is where we're at, Florida is number 5 in the nation for foreclosures. 5,400 filings. 1 out of every 1,700 people is in foreclosure. Now that's 1 out of 1,700. That's not a real high statistic, but we are number 5 in the nation. That means there's 45 states that are doing better than Florida right now. That means we've got a lot of homes going into foreclosure, and this is just a beginning of a trend. Let's dial in a little bit deeper. Take a look at the overview of Florida market. Now this is tracking just an average of total sales for the last 6 months. This is data pulled from Realty Track, another site you can pull this information for free. They do have a subscription, but I pulled this from the free site, not from the subscription site. The subscription site is if you want to use it to search to buy foreclosures. I think it's a little early in the market. There will come a time where it's time for that, but I think it's a little early to be jumping in on that wagon just yet. But what this does give me is an indicator. If I look at my sales in the state of Florida, 58.5% of the sales that happened over the last 6 months were traditional sales. 4.3% were auctions, but look at this. 41.5% were foreclosures. 41.5% of all sales on average in the state of Florida in the last 6 months were foreclosures. That's a huge percentage of homes being foreclosed on and hitting the market. That's huge. That is almost, and it's not quite half, but it's almost half of the home sales are foreclosures. That tells you that we've got a lot of people out there that are in trouble. They're losing their homes, and this is just the beginning of the next wave. Let's dial this in a little bit deeper. Now we're looking at Brevard County. This is our micro market, dialing it down in a little tighter. If I look in Brevard County, 73.2% of all sales were normal, 26.8%, so more than a quarter of all sales in the last 6 months are foreclosures. That's still a significant high amount. That's a significant amount of sales that were foreclosure sales that didn't hit the regular market. That means these people are losing out on equity, they're losing out on an opportunity to sell. That's an indicator that we've got families in trouble and an early change in the market, something to be able to look at. You need to watch these indicators because I can't stress this enough. I don't want to ever see any of you overpay for a piece of investment property. You always want to know what you're buying. You want to know how much income it's going to generate. You want to know what your profit strategy is going to be as you get in. So you need to know your market cycles. You can track your market cycles by looking at these 5 indicators. Excuse me. Every now and then I get this little catch in my throat.
I have a
Question?
Yeah. What's a good indicator to know on when to buy a foreclosure?
When's a good indicator to know when to buy a foreclosure? When you start seeing foreclosure sales account for about 30%, let me back up just a little bit here. Our foreclosure sales here in Brevard County are 26.8%. As that number ticks up and I start to see about 30% of our sales or greater are foreclosures, then that's a good indicator to start looking for foreclosures. Because now you're seeing a saturation of foreclosures and pre-foreclosures. Out of that, 23.2% of those were pre-foreclosure sales, meaning they were sold before the auction. So it was a small percentage of about 4% that actually went to an REO stage and was sold as a foreclosure, but a good portion of them were sold pre-foreclosure. When that number starts to get to be about 30%, that's a great time to jump into the foreclosure market and start looking, okay? So know your market cycles, study these indicators that I've given you, and I'll give you the websites to get at them in just a minute. And most importantly, buy at the right price. Now, I recommend you keep your values. When you buy a property, you want to pay about 2 to 4 times median income. Now, I mean median income, not average income, median household income. You can look at median income and you can find information on what an individual's average income is, but you want average household income because most households in America have 2 working adults contributing to supporting that household. So we want average household median income. And I say 2 to 4 times because that's still in an affordable range. These low interest rates were enabling people to buy 4 to 6 times above median income, but with these interest rates changing, you need to hold that down. 2 to 4 times is where you want to be. And most importantly, you want to know what the rents are going to drive. Now, if you're not sure about your rents, you can ask a good property manager and make sure they're not selling you blue sky, because most realtors don't have a clue what it's going to rent for. Most new investors don't have a clue what it's going to rent for. Some property managers are going to tell you what you want to hear instead of what it actually rent for, and then you'll be mad at them later if you go with them. So make sure you do a little bit of your own rent survey. You can do your own rent survey by looking at Zillow to see what's going on in that zip code and what other homes are listed for. You can also use a site called rentometer.com, R-E-N-T, letter O, word meter, rentometer.com, and that gives you a pretty accurate report on what you can do for rent. You can also pull rental lists from several other places. Zillow, I mentioned, Zumper, Z-U-M-P-E-R. Most important thing is know your rents. Don't take anybody's word for it. If you were to call me and ask me what it would rent for, I'd like to think I'm going to be pretty accurate, but I'm human. I make mistakes. You need to also do your own rental research. You need to know, because at the end of the day, if I'm wrong, I'm sorry, and I'm going to do everything I can to correctly, and I'm going to honestly own up to it. But if I made a mistake and you let me get away with it because you didn't do your homework, I hate to be this blunt, but it's still your fault. It's your property. You need to do your homework. You need to always know what you're going to get out of it before you go into it. Don't take somebody else's word for it, no matter who they are. Always, always verify. Let's take a look at our local market. Remember I mentioned that you want to pay about 2 to 4 times median income? So I pull this down from census.gov, where it gives you all kinds of cool data. If you're a numbers nerd and you really like to crunch charts, this is a great place to look for more stuff than you know what to do with. But I go to census.gov and I'm looking in Brevard County, and you can dial this in by city. You can dial it in by state. You can get as narrow or as broad as you want. This is a really cool site to be able to use, and it's free. But I look at Brevard County, I see my median household income about $59,300. So if I round that and just say it's roughly $60,000, that means I want to buy my rental properties at $240 and below. Now, admittedly, that's getting very tough to do here, but you can do it. I'm in contract on one right now at $125. Needs about $25 to $30 in repairs, and it'll rent for $1,500 to $1,600 a month. You can find those, and yes, that was an MLS listed property, so they are out there. You just need to be working with somebody who knows what they're looking for and can help you find those right deals. If you're local, then it's easy to get out in the streets, but if you're not, you need to be connected with the right individual. And if you don't know somebody, give us a call. I'll connect you with somebody who can help you to find those things. But make sure you're not paying more than about 2 to 4 times. If you've got lower interest rates, maybe you can go a little bit higher because you're still going to cash flow. And the secret to rental property is cash flow. Never, never, never buy a rental property with speculative appreciation hopes, especially in this market where we're seeing all our trends are looking down. I see people even today that are buying rental property. They're $100 or $200 a month negative on rents because they think it's going to appreciate another 10%. Well, if you're buying a property at $300,000, you think it's going to go up 10%. Now it's worth $330 a year from now. So to make that $30,000 in equity, they're thinking $200 a month negative or $2,400 is a good investment. But if we're at the top of the market, and you buy it for $30,000 and it doesn't keep going up and it starts to go down, and your negative income, as soon as a major problem happens on that property, your AC goes out, the roof starts to leak, a refrigerator breaks, and now you got to come out of pocket more money to fix it, all of a sudden you're what we call a motivated seller. You're supposed to be an investor who's buying an income stream, not a motivated seller looking for an opportunity to offload something. So be careful. Don't overpay for a piece of property. Focus on your median household income. Know your rents. Now, I pulled this down from a website called departmentofnumbers.com. They used to track a lot more cool data than what they do now, but they do still track some really cool data. And you can dial in and look at rental rate by state or by municipal area. So here we pulled down Brevard County. You can see it compares the U.S. rental change, Florida overall, and Brevard County. So if I look at the U.S., rents in 3 years from 2019 current have gone up 0.8%. If I dial into Florida, 0.42%, but now if I get to my micro market and look at Brevard County, my average rents have gone up 2.8% on average. Now that I could dial that in and look at each city because I've got areas where rents have gone up 10 and 15%, very significant increases, but overall across the county, just under 3% increase. That's a big change that's happened in 3 years. So you can really start to see which way your market is trending and see what's going on. You need to know what's happening with your market. We've also got another interesting dynamic that's happening right now in our mortgage market. That's our interest rates. We've seen those go up dramatically just in the last month and a half. See, low rates usually means increased affordability, but higher rates is going to result in lower prices. And we're starting to see that now in our local market. We've had 30% increase in inventory over the last 30 days. That's huge. And I believe a lot of that increase is attributed to fewer buyers being in the market because the higher interest rates have made those homes unaffordable. The result's going to be sellers start to drop their prices and ask less. It's going to create a stabilization in the market, which we need not only to create a healthier market, but also to create a better opportunity for us as investors. Now here's where you can pull off this information, and hopefully you can see this, these websites on your screen here. We've got tradingeconomics.com, departmentofnumbers.com, realtor.com, RealtyTrack, no K, T-R-A-C, realtytrack.com, the National Association of Home Builders, or NAHB.com, and then finally census.gov. These are great places to pull this information. This is where I've pulled all these charts. These are all free sites that you can get into and things that I definitely want you looking at. You can look at these indicators and tell what's going on in any market. I don't want you to ever overpay for a piece of rental property or an investment property of any kind. You always want to know where you're getting into, and this will help you to make sure that you're getting into. Did we have any other questions that I just skipped over? Because I know I rushed through that information and I didn't really take time to ask any questions. We had one in there about foreclosures.
We have nothing on the screen.
Okay, so if I got no questions, that means either I bored the heck out of everybody or we did a really good job covering this information. Either way, I hope you're blessed by this information. I hope that you go out and use this to research whatever market that you're investing in so that you can become a successful investor. Because remember, an informed investor is a successful investor, and my desire is for you to be as successful as you can be. Thanks for joining us. Everybody have a good night.